Hello, I'm John Kraeutler. Welcome to This Week in the Market. As we await the monthly jobs report later this morning, the Federal Reserve was center stage this week. On the Friday before the holiday weekend, the bank's stress tests were released. The 20 largest banks all passed the test. The largest of those subsequently announced share buybacks and increased dividends. On Wednesday, the minutes of the meeting in June of the Federal Reserve were released. While there was unanimity of pausing rates in June, there was a debate of whether further rate hikes were necessary for the rest of 2023. Of the 18 members, only 2 thought they should stay on hold for the remainder of the year. 12 of the 18 thought 2 or more rate hikes were still necessary. In the bond market, the yield curve still stays inverted. The 2-10 spread is at 100 basis points, with the 2-year Treasury approaching 5% and the 10-year Treasury approaching 4%. Stock market indices stayed in the tight range, awaiting the jobs report and corporate earnings season starting next week. The one thing I'm looking for in corporate earnings this year is a decrease in input costs. While we've been talking about increased costs for the last couple of quarters, I think we will start seeing a balance now between increased costs and decreased costs. It might be sector specific, but I'll be keen to see which companies are able to work with their suppliers in order to achieve better earnings. I say this because there has been a dichotomy between the PPI, the Producer Price Index, with a sharp deceleration in the last 6 months, and the Consumer Price Index, specifically core CPI, which has drifted lower at a slower pace. Next week in Macro Minute, I'll go into this further, as with the implications for the markets and the economy. Thank you again for watching This Week in the Market. I'm John Kraeutler, and have a great week.